Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Stock surge, yields plunge as U.S. CPI data stirs the hopes that the Fed hikes are over. But Ken Griffin and Jamie Dimon are warning red flags.
But I still think you should prepare. They might have to do a little bit more. And I think people should be prepared for that, just as a kind of a risk management tool. And I'm afraid inflation may not go away that quickly.
China's Xi arrives in the U.S. ahead of high-stakes talks with President Biden. Military communications, export controls, and fentanyl top the agenda. Burry bets the money manager is once again long Chinese e-commerce giants Alibaba and JD.com after giving up on them just a few months ago. A very good morning. Let me just show you what the makings of a hard pivot might look like. This is the U.S. Treasury market. It was a collapse yesterday of over 20 basis points on the 10-year paper. We're back in the green for U.S. Treasuries for 2023. For U.S. Treasuries, we're back in the green. Global treasuries are perhaps clawing their way back to the green. That is the manifestation of lower CPI. And again, where do you want to hide? The shorter end of the curve, that is the question. Bonds, I mean, it was a seismic day for treasuries. Did the higher for longer just get slayed? That's the question that goes through my mind. Small reprieve this morning after a 20 basis points move yesterday. From the US to the UK, the UK 4.6% this morning on their inflation data. That's the lowest since 2021. The market is now baying for 50 basis points of cuts in the US by July 2023. So are we moving to a hard pivot? Certainly, there's a warning sign from Ken Griffin. Says the Fed's credibility is there. It's at risk if they shift on rate cuts too soon, on rate hikes, I should say, rate cuts too soon. Cable is down. It did have a monster move by 1.75% yesterday. So we saw quite a magnificent move, drop in the dollar and a rise in sterling, a rise in the euro dollar. So you are just looking at the cable this morning at 124.65. Again, the market pricing in 78 basis points of cuts by the end of next year. Iron ore, I thought we'd give you a little soupçon of the commodities. You've got this China stimulus story out there. We've hit $130 for the first time since March, just backing off from there. We've got $137 billion going into the housing sector. So stimulus abound.
And the euphoria is still alive and well, whether you're looking in Asia stocks or U.S. stocks too, Manus. They're taking heart from the cuts priced in the market, but how long can that last? Gains continue this morning, up at least 0.2% for the S&P and Russell. Now, if you look at the contours of what rallied yesterday, it was really led by the most short stocks. The most short stocks, a Goldman Sachs basket of that, rallied 7% yesterday. That was its best day since November of 2022. Also, the best day for the Russell 2000. This thing rallied more than 5% yesterday. Small cap stocks have been beaten up. They come back alive with some serious force yesterday. And again, the gains continue today. Now, Asia Pacific needs to play catch up with the U.S., so it's up 2%, 2.3%. But, Manus, it's also getting a boost from that stimulus, that China stimulus that you mentioned. The question will be, how long can this continue? How long can the euphoria filter through both stocks and bonds, which I should say we're in the midst of the best 3-week gain for stocks and bonds so far this year? Perhaps the Fed officials come to spoil the party, Manus. And what we've already heard from both Goolsbee and Barkin yesterday fight against that proclivity to price in that euphoria. Barkin said not convinced that inflation is on some smooth glide path to 2%. Goolsbee, for his part, said progress continues, though we still have a way to go.
Well, of course, there's words of caution. Ken Griffin, as I said to you, said he's at Citadel. More from Shanali and her conversation with him later on. The Fed's credibility is at risk if they cut too soon. The market's giving 50 basis points. You know, the question is this. Is Jamie Dimon right? It might not go away just so quickly. And of course, we have the other dynamic, which is, are we seeing 1995, a 1995 redux? But we'll talk more about that in a moment with our guest host. We have this slowdown, Danny, inflation. It's boosting the bets that the Fed is done. Citadel CEO Ken Griffin, I've just mentioned him, spoke exclusively to Bloomberg that to go too quickly could be a mistake.
The Fed needs to stay on message that they're going to put the inflation genie back in the bottle. And so if they cut too soon, I think they risk losing credibility around their commitment to a 2% inflation target.
Well, our next guest weighs in on the Fed's next steps, writing this. You don't have to remotely worry about the Fed hiking again, and the recession isn't here yet. Markets are likely to put their squeeze cap on and aim at the moon. Party like it's 1995. What does Alfonso Peccatiello mean about 1995? He's the founder, the CEO of Macro Compass. Of course, 1994, the Fed hiked rates from 3 to 6%. Job growth still continued. It was the very, the very personification of soft landing. Are we going to have a magnificent soft landing 2024? Good morning.
Hey, morning, Manus and Danny. So look, 1995 was actually the only episode of soft landing ever recorded. In 1994, the Fed hiked rates, but in 1995, despite all the fears of hard landing, job growth was relatively stable and inflation went down to 2.5%, and the Fed could cut rates in the second half of 1995. That's exactly the setup that the market is pricing today. The market is looking at, if you look at the S&P 500 forecast for 2024, you have investment banks calling for anything between 4,800 and 5,000. Roughly, that's the median expectations for the S&P 500 next year. Now, if you look at what that means earnings per share 10 to 12% higher. That means the Fed cutting rates about 100 basis points next year, which basically is only possible if inflation continues to move down gradually and predictably towards 2%. Pretty much, we're pricing a picture-perfect market right now. And I think it's important to understand because you always invest against consensus. At consensus, it's basically parting like 1995.
Right. Well, Alfonso, on that, it's not just stocks. You know, Manus called me this morning and said, hey, Danny, can you make a chart of what bonds have done for the year? And I got really excited because I charted global bonds. Yeah. Well, thanks to you, Manus, because you forced me to do extra work, which, you know, apparently I'm always happy to do. But if you look at the blue line on there, that's global bonds, still negative for the year. But U.S. bonds, the U.S. bond ag, Alfonso, is now up 0.4%. We've erased the losses in this American bond market. Has the bond market run ahead of itself? Can this last into year end in the next year?
You know what worries me here, then, is that inflation is always and everywhere a monetary phenomenon. An economist a bit more famous than me once said that, right? And the issue is that money has been dried up pretty aggressively over the last 18 months, especially on private sector credit. If you look at mortgage applications, they're the lowest since 1995. If you look at the yields that small cap companies are paying to borrow, it's around 9 to 10%. So money is pretty tight. And with a lag, inflation has indeed slowed pretty aggressively. But now think about the opposite. If you keep loosening financial conditions, exactly like we are doing today, if this bond market rally extends further and further without the Fed trying to stop it too prematurely, what happens is that you're loosening financial conditions, you restart again the credit engine machine, and what happens mid-next year, in the second half of next year, exactly what the Fed was fearing, this 1970 setup where inflation does not go smoothly to 2%, but maybe it picks up again to 3 or 4%. So I think it's too early.
How big a risk is there of that, Alfonso? I mean, you know, let's be honest. Fool me once, shame on me. Fool me twice, shame on you. The banks have been bitten numerous times. They've tightened FCON. They've reduced credit cards. We've spent all our money. Come on. I mean, all right, the bond market's done the heavy lifting, but do you really think FCON is going to get that louse again?
Well, the situation here, Manus, is that it's true that we are so far looking at a soft landing. It really looks like and it smells like one. The only problem here is that the Federal Reserve has to retain credibility. They can't loosen too aggressively. This is not 2019, when Powell showed up in January and said, sorry, guys, we tightened too much. The stock market was down 20% in the last quarter of 2018. We need to loosen financial conditions because inflation was already at 2% back then. Today, you are not there yet. So Powell can't proactively ease, and I think he won't proactively ease to preserve credibility. And that's really the fine line that can put everything at risk.
Alfonso, only a few minutes ago, we got the EU Commission's Eurozone growth forecast. They lowered it to 0.6% for 2023. It had been 1.2% for 2024. So that's significantly weaker than their first estimation. If you're comparing the EU, let's throw the UK there, and the US, who's likely to cut first?
Well, as I said last time I was on the show, I think the European bond market is much more attractive than the US bond market. Well, since then, the European bond market has rallied aggressively. But the story is that all central banks around the world have tightened pretty much to the same extent. If you exclude Japan and Switzerland, all other central banks have tightened aggressively. Now, the situation is that while the US private sector is much more insulated from this tightening, you can't really say the same about the European one or the UK one or the Swedish one or the New Zealand private sector, for example. Maybe even Canada, I would put into that basket. So those bond markets and those economies are the ones that are more likely to break, where people keep obsessing about the United States. There's an entire world out there which has tightened aggressively, even though they are not equipped really to handle this kind of tightening. Europe is amongst those.
When you look around the bond markets this morning, there's been these significant moves in gilt, significant moves across all global bonds. Aussies playing that classic catch-up. Do you think that we were so long going into these numbers? I mean, the CFTC data had us the longest on bonds since 2009. If you had to make a choice now about where to hide, as it were, on the curve, would you still be more drawn to the short end of the curve rather than taking duration, given the risk that you've just outlined that you could have whipsaw in inflation, as Jamie Dimon, he's a little bit more famous than all of us actually, suggested overnight? Just a thought, Alfonso.
Just a little bit.
Yeah, little tiny.
Just a tiny bit, yes. So I would defer to him. But if I would have to share my humble opinion on the curve today, I think one of the most crowded trades in the street in bond markets is to be in yield curve steepeners. So basically, the steepener, the main thesis here was that the curve was going to steepen because, you know, the front-end yields were going to drop, and so inflation would be coming down, and the labor market would weaken, so you could buy 2 or 5 year bonds, but the economy wouldn't collapse. So you were going to get a typical steepener that you got, for example, in 2019. Now, that is still, I think, the main thesis around in hedge funds and in the macro community, and the bear steepening instead that we got validated the trade for the wrong reasons. I think it's very, very, very crowded, Manus, where everybody has the steepeners on. Yeah. You can see it yesterday where inflation really disappoints, and yet you can't really get the curve to steepen anymore. So what that tells me is that there is a very crowded trade. Everybody wants to be long 2 years because they say, look, I can get this 5% yields locked in. If something goes wrong, I make a ton of money. So 2 years is the place to be. Generally, my experience, when a trade is very crowded and when it looks very obvious, it's not necessarily going to pan out.
Yeah, gone from -16 at the end of October to -40, where we are right now in 2's 10s. Alfonso, thank you so much for joining us. Alfonso Peccatiello of Macro Compass. Manis, let's get to some of the other top stories that are trending on the terminal this morning. Schonfeld has ended a partnership talk with Millennium. Ultimately, Schonfeld backed out after securing up to $3 billion in verbal commitments from new and existing investors, including pensions and Middle East sovereign wealth funds.
Germany's top court struck down a key element of the government's plans to address climate change and transform the economy. That deals Chancellor Olaf Scholz's coalition a major setback that could throw its budget policy into disarray.
And Israeli troops entered Gaza's Shifa hospital compound as part of a precise and targeted operation against Hamas. The move runs the risk of raising international ire if it ends up causing more civilian casualties.
Well, coming up in the show, the Democrats agree to pass a proposed spending bill. It's a rare form of bipartisanship. But the shutdown is not yet averted. We'll discuss. Danny.
And later in the hour, we're going to be speaking with China expert Bonny Lin of the CSIS on today's high-stakes meeting between President Biden and President Xi. This is Bloomberg. This is Bloomberg Brief. I'm Danny Berger in London. Manus Cranny is in New York. U.S. House lawmakers, Manus, overcame partisan animosity to pass a temporary government funding bill, and now it greatly lowers the risk of a shutdown. Let's get over to Kate Ackley of Bloomberg Government on this. So, Kate, it passed the House. Does that mean we've avoided a shutdown altogether? What now?
Well, it still has to go through the Senate. and it's expected to pass in the Senate. But you know how the Senate is, there are all kinds of procedural hurdles. So we'll see. It could be soon, it could be a few days, but I think the idea is that a shutdown is more or less going to be averted.
I mean, it's hardly what you call good fiscal governance. It's really just kicking the can down the road, isn't it, from the end of this year? I think you said they get to go on holiday in Capitol Hill. But we come back to this mess in January and February, don't we?
Right. You're going to have now, you're going to have to do 2 shutdown clocks, because there's going to be some of the federal government agencies, their funding will run out in January, and then another tranche of federal agencies funding will run out in February. So the idea is to kind of, put the pressure on lawmakers to move that first tranche and then the second in time. But this is a new kind of plan. This was something that Speaker Mike Johnson and House Republicans came up with, even though a whole bunch of House Republicans voted against the plan yesterday.
I mean, Manus, how are we going to do this on Bloomberg TV? Are we going to have 2 shutdown clocks? Is the graphic engine strong enough for that?
I don't think I've got the mental strength to actually get through another shutdown, showdown, hoedown kind of thing.
Yeah.
It's like, every time you turn around here, it's like it's managing by crisis on a string, isn't it?
Yeah. Welcome to America, Manus, is all I can say. And Kate, on that note, I mean, who are the winners? Is this a win for Johnson, or does it complicate things that it was really Democrats that helped get it over the line?
Well, the answer is both, really. And they're all kind of taking this as a win. This is a win for Speaker Johnson. He's avoided a shutdown in his first, less than a month on the job. But we're sort of grading him on a curve, right? This is just the very, very minimum kind of doing the job, if you will. So he's managed to get, this bill through the House with actually big bipartisan support. And so it is a win for Speaker Johnson. How long-lived of a win is it? There's some signs that he has problems in his own conference. You had a number of Republicans, some of the chair people, like Jim Jordan, vote against the bill. So there are signs of problems to come into the future for the new speaker.
Okay, and of course this bill went through, the White House has asked for, $106 billion in aid for Ukraine and Israel. None of that is in this bill. So, I mean, that just shows you where we are, how prickly this is. Kate, we could spend longer on this, but we'll be back to you. Don't worry. There's 2 new countdown clocks. Danny's looking at one, and I look at the other. Kate actually there on Bloomberg Government burning the midnight oil. Danny has made a good point. U.S. Treasury bonds are in the green again for this year. But, of course, you've got this carry-through from that lower CPI yesterday. It was a re-rating across the bonds. Let's have a look at them. Aussie bonds, you've got U.S. Treasuries down 20 basis points yesterday, Danny. And Alfonso warned us there from, Alfonso Peccatiello warned us that this may not be like 1995, where we see this risk parity trade up in everything.
And the other thing he pointed out, if we look at the global bond market, it's still down 0.3% on the year. Yes, they've rallied over the past 24 hours, maybe continuing that rally. But Alfonso was saying to us, Manus, that this is where he wants to buy because the global economy is more weak than the U.S., and there will be cuts in Europe, for example, before the U.S. Okay, much more to discuss here on Bloomberg. We'll have a little bit of your sports news coming up on Bloomberg.
It's Bloomberg Brief. I'm Manus Cranny in New York. Danny Berger is in London. He's Irish. He's well known. Not me. It's Rory McIlroy. I mean, this is a cracking
Both
story.
Both great at golf.
Well, I wouldn't be so bad as like Alfonso to say perhaps he's a little bit more famous than me. He is from the same part of the world, from Northern Ireland. Rory McIlroy resigns from the PGA board. I mean, this man has got form. I will give him this. He's got principles. He stepped down from the PGA Tour. He has been vociferous in his condemnation and his dislike of live golf, hasn't he, Danny?
Yeah, I mean, you do got to feel for the man. He was one of the few people who were really outspoken about his dislike for Liv when it started. And then after the merger, he made no secrets about it, that he was blindsided and stung from the deal. I looked up what he said the day after the deal happened, the PGA-PIF one, which, of course, is still trying to work itself out. He said he felt like a sacrificial lamb, that he stood up there and said his feelings, and this is what happens.
I just looked at the New York Times article, and he said, "I hate Liv. I hope it goes away." And of course, you know, we're still in trying to get that deal closed. I mean, this is an explosive thing. I hate Liv. McIlroy, one of the new circuit's most fearsome critics, said on Wednesday, like, I hope it goes away, and I would fully expect that it does. Of course, that is not the situation for him. So that's contentious. But of course, Manchester United never far from a story as well. We've got Leon Cooperman punting a stake. Well, I don't know, taking a stake, a million shares, so 17 million bucks. Leon's putting into Manchester United this morning. There you go. There's Manchester United at £18.83. Yep.
Maybe making a bet that a deal is soon to come. Will it be Ineos? Will it be Jim Ratcliffe? We'll keep you up to date on that deal when it happens. But coming up first, Manus, we're going to speak about President Biden's meeting with Bonny Lin.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. Stock surge, yields plunge as U.S. CPI data stirs hopes that Fed hikes are over. But Ken Griffin and Jamie Dimon are waving warning flags. China's Xi arrives in the U.S. ahead of high-stakes talks with President Biden. Military communications, export controls, and fentanyl top the agenda. And Burry's bets. The money manager is once again long on Chinese e-commerce giants Alibaba and JD.com after giving up on them just months ago. Well, if you had given up on this equity market, today would have been a bad day for you. It was a bad day for the shorts, the biggest short rally since November 2022. You can see that just by looking at the Goldman Sachs most shorted index. 7% is how much higher we moved. Small cap stocks also surged with that, over 5% for the Russell 2000. And we're higher yet again this morning, 0.3 for the S&P, nearly 0.5% for the Russell 2000. However, Dan Suzuki over at Richard Bernstein, the CIO, says that this market is not moving in line with fundamentals, and he would fade the extremes unless something changes. China, good news there. Also more stimulus coming from the Chinese policymakers. So not only does China and the MSCI Asia Pacific Index, Manus, play the catch-up game, it also gets an extra boost for that. So up on the day about 2 1/3%.
Yeah, a lovely Santa Claus rally, perhaps coming a little bit early. When you look at the bond market, you just got to ask yourself whether higher for longer really just got slayed yesterday on the back of the CPI in the USA. And, of course, in the UK, inflation at the lowest since 2021. But look at this, quite a dramatic 20 basis point move yesterday. It's a very, very crowded trade, according to Alfonso Peccatiello, who we've just spoken to, which is the curve steepeners. That is your risk. The market is also pricing in 50 basis points of cuts by July of next year. So the market is perhaps getting a little bit ahead of its skis. Roll it over, have a look at the cross assets, and you have, again, where do you want to hide? Do you want to be in the short end of the curve? Ken Griffin at Citadel, we'll hear more from Shanali and Ken Griffin in just a moment. The credibility of the Fed is at stake if they cut too soon. So you're seeing a small pull up higher in these yields this morning, 484 sterling. I mean, the dollar took a massive smack yesterday, so there's a little bit of reprieve. Sterling is down by 0.25% as we see that inflation come in at 4.6%. That is the biggest drop in inflation in the United Kingdom since 1992. And the market is now pricing in 78 basis points of cuts in the UK by the end of next year. Iron ore has put a little bit of green on the screen. We're above $130 on iron ore for the first time since March. And again, this goes back to the stimulus narrative down from the Chinese, $137 billion going into the Chinese housing market. So again, as Xi lands in the United States of America, he's dealing with some stimulus aspects at home in China.
And then amid all this everything rally, Manus, I really like what Alfonso said that we've been hearing more of. This idea that you'll be restarting the credit engine with looser financial conditions because bonds and stocks have rallied. So he said what happens mid next year? It's the 1970 setup where it doesn't go smoothly back down to 2%.
And I think his biggest fear was, you know, the perfect soft landing was 1995, which is where employment still continued to grow. The Fed had hiked rates in 1994, and we had this risk parity event of everything surging. So the question you need to ask yourself now is, what is my risk of a massive risk parity updraft and 1995 redux in 2024?
Well, maybe we can also rally off the back of less benign geopolitics. You'd mentioned this, Manus. We have Biden and Xi meeting today. It's been much anticipated. The expectations is that it can maybe thaw some of the tense relations. Citadel founder Ken Griffin also spoke exclusively with Bloomberg Sonali Basak in Miami on his hopes for the outcome.
It's really important that we try to find common ground to build a better relationship with China on, rather than continuing this downward spiral of tit for tat on trade policies and otherwise. Our economies are incredibly coupled together, and an abrupt decoupling would come at just catastrophic costs to the people of both countries.
Joining us now to discuss this is Bonny Lin of the Center for Strategic International Studies. Bonny previously served in the office of the U.S. Secretary of Defense as a senior advisor for China. So, Bonny, we're really appreciative for you to make the time to join us so early this morning. For you, looking at a meeting between Biden and Xi, what would be success?
Well, thank you for allowing me to join you this morning. It's a pleasure. In terms of looking at the meeting and what would be successful, I think the administration, as well as the Chinese side, have been trying to set low expectations for those tuning in and watching the meeting. Part of it is the recognition that U.S.-China relations, prior to this meeting, it had been improving slightly, but there is still a lot of hard issues between the two sides, including Taiwan, that this meeting is not going to solve. A couple of deliverables that folks have mentioned might come, or potential outcomes that might come, top of the list include improving military-to-military ties. There's also discussion that we might be able to get some agreement from the Chinese on China working to curb the export of precursors for fentanyl. And of course, there's also been discussion on potential U.S.-China agreement on being able to regulate how artificial intelligence might be used in controlling autonomous weapons, as well as potentially the use of artificial intelligence in the control of nuclear weapons. But I think we should have reasonable expectations that this one meeting is not going to significantly improve U.S.-China relations or reset the relationship.
Bonny, look, both sides need one another, and they're at pains to sort of emphasize that from the U.S. that they don't really want to fully decouple. But when I look at, you know, Xi has had a collapse in foreign direct investment into China. Economically, he's under pressure. I just wonder what would be a win in the domestic news narrative and the economic narrative for Xi at this, because, of course, there is progress towards ending the freeze on Boeing. You know, we've got a lot of tech angst. So what would be a win for Xi to arrive back in China and say, this is what I achieved with meeting with the President of the United States of America for the economy?
Oh, that's a really good question. I think we might not know until after APEC. We do know that one of his agendas, exactly like you said, is to cater to investment from the United States. So aside from the meetings that he has with President Biden, as well as meetings that his delegation will have with some of the other U.S. folks on the U.S. side, he does plan to attend a CEO summit. And I do expect during that summit that he probably will be looking to make the case of why it's still in the interest of U.S. businesses to invest in China. So hopefully he might see some wins from there. The other thing is, I think it's an optics issue for President Xi Jinping. When he arrived in California yesterday, he was greeted by Governor Newsom. It's a very wonderful optic for him as an international leader to be welcomed to the United States, to showcase that he can manage U.S.-China relations. And that helps address some of the domestic criticism that we've been hearing that he has been at least facing at the mid to low levels within his government.
Is there not also an optics issue domestically in the U.S. for Biden? Because we've long talked about this idea that China opposition is the only thing that unites both the right and the left in America. Does Biden also need, or is he expected to tread more carefully because of that China critique?
He's definitely treading carefully, and that's, I think, why the Biden administration is trying to set low expectations from this meeting. The engagement that the United States has engaged with the Chinese side has already led to, as you're well aware, significant criticism from a number of leading Republican candidates. And I think what President Biden needs is something positive that he can point to. And I think what he is looking for, or what would be very positive, at least on the domestic side, would be if we can achieve any clear agreements on fentanyl. As you know, an issue that has major domestic implications for the United States.
Yeah, I mean, that would be a significant social flag to carry through in the United States of America in 2024. You mentioned Taiwan in sort of the very first breath. You mentioned Taiwan, and yet here we are. We have a Taiwanese election at the beginning of next year, and we have a U.S. presidential election next year. The world is talking about Ukraine, Russia-Ukraine, and Hamas-Israel. But there is an unspoken level of tension in the Taiwan Strait. You know, what could be said around that could alleviate that as a key pressure point in 2024? Because Biden does not need that going into his election run at the end of next year, does he?
I completely agree. And I would say probably no U.S. leader needs another potential third crisis or conflict. So I think the Biden administration is being very careful here, mainly because they're aware that anything that President Biden may say to Xi Jinping during this meeting, there is a potential that the Chinese side may have incentives to share that publicly. We've seen some of that in prior high-level meetings. But President Biden does seek to use this meeting to make sure to reiterate many of the assurances that he has already provided China with respect to Taiwan. That includes, for example, making clear that it is not the policy of the U.S. government to support Taiwan independence, as well as making clear that the United States is not seeking to use Taiwan as a card to contain China or as a card against China. A lot of these assurances President Biden has already provided to Xi Jinping at the Bali meeting, the last in-person meeting between the two leaders last year.
And if there are talks about arms controls between the two leaders, can China bring Russia along on that too? Is that something that China has the ability to bring to the table?
That is an excellent question. I think it would be quite difficult given the state of U.S.-Russia relations, but we will need to see. And I think it would be an excellent first step if we can reach any arms control agreement or even have good substantive arms control dialogue with China to begin with. And then from there, we can see what we could do with Russia, too.
Okay, Bonnie, let's see what the day brings corporately, politically, on all of those touch points. That is Bonny Lin of CSIS on Xi Biden meeting. Coming up, we're going to hear from the man himself. We talked about him quite a bit, Ken Griffin, on why he believes working from home could mean more job cuts. Get yourself back to the office quick. Shonali Bassik is on tour. She needs to come back quickly. We'll talk about Ken and Shonali in a moment. Bloomberg Brief. I'm Manus Cranny in New York. Danny Berger alongside me in London. So the labour market recovers from the pandemic. Companies are trying hard to get their employees back into the office. The Citadel CEO Ken Griffin discusses the downsides of working from home.
It's been really hard to hire people. And as such, your large companies have been very reticent to let people go no matter what the circumstances are. So even if margins are contracting, even if you have gains from automation, people have been very reticent to let people go. Now we're starting to see for the first time the unwinding of that labor hoarding. What we don't know is how much of that labor hoarding has taken place. And then what worries me in a in a hybrid work environment or work from home environment, the cultural or social contract that holds people together in a company is unquestionably weaker. I mean, we've all read about companies that have fired thousands of people on Zoom calls. There's no sense of, that's Jane who's worked down the hall with me for years, and I'm going to go the extra distance to try to keep Jane employed here. It's like, here's the email to all, here's the video conference with a bunch of people, and goodbye. It's a very different moment in American employment history where I believe the bond between the company and the employee has become far weaker. And that worries me in terms of the willingness of corporate America to make cuts on their workforce that they just wouldn't have made at other similar points in the labor market cycle.
Is that you saying that the employment market will crack much more significantly than many are expecting?
It could, is what I'm saying. It could. It's a wild card.
Words of warning there from the Citadel CEO Ken Griffin, speaking on a wide-ranging conversation with our very own Shonali Bazik, who's in Miami. Shonali, thank you very much for getting up early. Great work yesterday, great conversations, and you made lots of headlines. What's not to love? Now get back here to the office, because that's the risk, isn't it? We love, you know, it's all about being together at 2:30 in the morning. Just saying.
It certainly is. I know I need to get back as soon as possible because, you know, who knows what happens if I don't. But the interesting thing, too, you know, he had a lot to say about the economy, and I think you saw a lot of this reflected in the 13F views also in terms of that fear about the future of the direction of the economy, didn't you? And his view about the labor market, he didn't want to call here a hard landing or anything of the sort, but you definitely did hear the caution, didn't you?
And it does feel, you mentioned the 13F filings that came through last night. Yes, it's backwards looking, but it seems like maybe that overriding fear is just manifesting itself in buy a lot of tech.
Well, that's interesting, too. Buy a lot of tech. But if you take a look at the holdings in aggregate over the entire investment community, in the first 5 holdings, you did see, for example, Amazon in that list of holdings, Danny. But in aggregate, you actually saw the entire investment universe as net sellers of the technology industry. And in that first 5 set holdings, you saw Apple, you saw AMD, you saw and a lot of big tech companies, Alphabet, as big sells in terms of position changes. And I wouldn't say this reflects a want to get out of the stocks, for example, but you definitely saw a lot of investors taking profits. Take Rocos, for example, and their approach to QQQ. You saw them pull back a little bit. And that big Michael Burry story also about them really reducing their exposure to the likes of NVIDIA. That was up 230% or so on the year. And so this profit taking and this worry at the same time about betting against the market, I think really shows you where people are right now.
Well, of course, you know, you mentioned Michael Burry, and we've got the 13F filings as well. He's taken another bite out of Alibaba and JD.com. Just for anybody that's tuning in, JD.com had their numbers this morning. Net revenue, 247.7. That is a beat. And, of course, it was Singles Day. Is also something that they touted around as being a driver for them. What is it? Fool me once, shame on me. Fool me twice, shame on you. I mean, this man's a smart man, Michael Burry. He's back in. He's in like Flynn again. And I mean, this is a hard pivot, Shonali. I got there. A hard pivot by Burry. It's called thinking on your feet.
It is a hard pivot.
Yeah.
And, you know, he's not the only one. You think about the people that had gotten out of stocks related to China because of the worries about the geopolitical tensions or valuations. Wimps, total wimps. But look at, as you say, they're right back in, aren't they? And, you know, I've got to say, even here at the Citadel conference that I've been at, there has been a lot of discussion about the role of China. And, you know, Griffin himself even talked about the inability to decouple from the Chinese economy, despite any worries about the Chinese economy or the tensions between the U.S. and China. Griffin even went so far as to talk about his advice to President Biden and trying to maintain both a stern tone when he is negotiating, but also a recognition of the U.S. reliance on the Chinese economy and vice versa.
Can I tell you guys something really depressing? Me, a human who lives in the UK, was for some reason served an ad for Singles Day, and it was a roast dinner for one, a discount on a roast dinner for one. I can't think of anything more depressing. Can I just say they haven't obviously been to the 3 formal settings that Danny has hosted over the past year. You know, what are you doing? Another what? A wedding? Okay, another one. Yeah. I've had a few wedding kind of celebrations. I don't think that's for TV to discuss. Anyway, Shonali, thank you very much.
I'm in trouble.
That is Bloomberg's Shonali Basak. Manis is going to get a talking to after this program. Anyway, Manis, shall we talk about Alstom?
Oh, yes, let's talk about that. I could do that without getting into a lot of trouble.
Let's talk about trains. Okay, so this is a company, a European company. It makes kind of all the trains in the UK, in the US. It makes subway trains. It makes DC Metro trains. Man, it's down by 20% today.
That's what you call a slap. I think that's like almost €1 billion of equity wiped out. Why? Because they're slashing €2 billion off their debt. They're cutting jobs. The market is now apoplectic about their balance sheet. 1,500 jobs to go. They're selling assets to raise cash. It's a bit like that gift that I'm going to buy you. I don't know what I'm going to sell.
Oh.
Yeah. Because now
it's going to be a $51 million
I actually feel really
right?
bad now. I'm in the naughty corner, aren't I? Yeah.
Manis, you could never be in the naughty corner. Don't worry, Manis.
Okay,
you know what will make me feel better? If you give us a check on markets, that will make me feel better.
I'll do that for you. Let's have a look because it's, live long and prosper like 1995. You're going to have the potential as these yields drop. I mean, we're steadying a little bit on the 10-year government bond yields this morning, 446. We did a 20 bip drop yesterday on that. SPOs are up a third of 1%. NYMEX crude down by 0.4%. Good morning from New York and London.
You're watching Bloomberg Brief with Danny Berger in London, Manish Cranny in New York. Let's get you set up for your trading day and take a look at what's ahead. First, we're going to get a lot of retail earnings. We have Target and TJX both reporting before the U.S. market open. And then it's a lot of data. U.S. PPI retail sales, both of them will come at 8:30 a.m. Eastern time. Current estimates showed that retail sales growth likely slowed in October, feeding into that disinflation narrative. And President Biden and President Xi holds a bilateral meeting at 2 p.m. Eastern outside of San Francisco on the sidelines of the APEC summit. President Biden holds a news conference afterwards. And then we're also going to be having the UK Prime Minister, Manis, holding a press conference at 4:45 London time. This follows after a ruling from UK courts. It broke only 10 or so minutes ago that his policy of sending asylum seekers to Rwanda is unlawful. So Rishi Sunak calling that decision disappointing. So he will be holding a presser in a few hours' time.
And of course, the debate there is what is plan B? Rwanda was the destination where they would take many of the people that did that horrendous journey across the channel from France, take them, put them into Rwanda. The Supreme Court has said that the plan is unlawful. There is a real risk of harm to people if they are sent to Rwanda. So, of course, Sunak is under this policy of stop the boats. So let's see what he's got to say a little bit later. Now, I haven't been to Target yet. You were extolling the virtues of Target before we went to the break. But we're going to get the numbers. And, of course, last quarter, their sales dropped by 8.5%, Danny. The question is whether the inventory drawdowns bolster the margin. Target is up 2.8%. NVIDIA barnstorming away ahead again.
Yeah. Extending gains. It had jumped to a record high. Here we go, about to hit another one. It's now matched the longest winning streak ever, Manis. So everything rally continues well on its way.
And not to be left out of course, Michael Burry covered his short on some of the semiconductors. That's it for Bloomberg Brief. We give you the surveillance team in unity on Bloomberg.